So starting this morning, we thought that we would talk about your hotel is worth what, and while it's not worth what it was when you opened your loans 3 or 4 years ago, it is, there are certainly some areas that we think that we can offer some advice or at least some case studies into.
I'm John O'Neill, and I'm Managing Director of Hospitality Advisory Services and a professor in the School of Hospitality Management at Penn State, where my teaching and research focuses on value issues. And so I wanted to present to you the Penn State Index of Hotel Values. The Penn State Index of Hotel Values is an econometric model that is used to estimate future hotel values by type of hotel. Let's start with talking about where we see hotel values going in the next couple of years. Last year, what I said is that I've found this recession to be very different from previous recessions, and particularly different from the most recent recession because of CRUD, or C-R-U-D. And I just wanted to update you on where I see those factors this year, because there have been some improvements. You may recall the C was consumer spending, the R was the residential market, the U was unemployment, and the D was debt availability. And those 4 factors, consumer spending, the residential market, unemployment, and debt availability, were the 4 things that I recommended last year that you keep tabs on to know when the recession is going to be ending. I think we're very close to that point now, and I'm much more optimistic this year than I was a year ago on all of those factors. Consumer spending, we've seen a little bit of improvement. Unemployment is still dicey, but we're seeing some markets where things are improving. The most recent statistics that I've seen as far as unemployment show that while we've had a decrease in employment, most of that is attributed to the census workers and their temporary employment ending. The flip side is, in the most recent employment statistics, private employment has actually increased slightly. So that's good news. Even though the overall employment is down, that is largely due to the census workers. And then as far as debt availability, there's still a lot of issues, and the bankers who I speak to are not optimistic about anything really changing in 2010, but there is some optimism about 2011. That will affect hotel values in 2011. But let's talk about 2010 first. As far as 2010 goes, we are looking at the biggest drop actually being in mid-scale with F&B, with a 5.9% decrease in that particular category, and economy, where there's an 11.2% drop. As far as 2011 goes, we're seeing things turn around a lot. Basically, the way that we're looking at hotel values right now is we continue to project 2010 being the bottom. And basically, the way hotel values, I think, will be in 2010 is it'll look like a U, where the right side of the U will be a little bit lower than the left side of the U. So by the end of 2010, things will be improving, but not being where they were at the beginning of the year. We are expecting more substantial improvements in values in 2011, where the biggest gain in value per room will surprisingly be the luxury segment. Last year, I think we were all very down on the luxury segment. I'm much more optimistic about that segment this year. So that's the biggest gain in dollars per room expected for 2011. And the biggest gain in terms of percentage is expected in the economy segment. Basically, what we found is through multiple hierarchical linear regression analysis that there are some factors which predict the sale price of a hotel and others which don't. There's some factors we looked at, like, for example, whether or not the hotel was located in a major metropolitan area, which we found just was not relevant. In other words, once you took into account the NOI, the ADR, the number of rooms, and the occupancy, that subsumed any other factors like the size of the metropolitan area or the age of the hotel, for example. So basically, if you look at a hotel and start with a constant, which if you're into statistics, that's what's called the y-intercept, a constant of a negative 42,873, you take the NOI on a per room basis and multiply it by 5.615, take the ADR and multiply it by approximately 615, take the number of rooms and multiply it by 33.693, and then add the occupancy times 234.891, you'll get an estimated value per room. Now again, it sounds complicated, so just to give you one quick example before I sit down, there's a courtyard in Bristol, Virginia, a fairly prototypical courtyard, with 175 rooms with a trailing 12-month occupancy of 61.2%, an average rate of $112.60, and an NOI of $1,856,000. If you take those figures and start with the constant of a negative $42,873, take the NOI per room times 5.615, take the average daily rate times 615.039, the number of rooms times 33.693, and the occupancy times 234.891. It gives you an estimate of $106,205 on a value per room basis, or a total value of $18,600,000. So the AVM estimate resulted in an estimate of $18,600,000 for the hotel. The epilogue is that the hotel was listed for sale for $20,500,000. It actually sold for $18,650,000. What I found with the AVM is if you use this AVM, and we went back and we looked at the AVM and actual hotel sales, and the AVM on average was within 10% of the actual hotel sale price on average. So it's a interesting, quick approach to estimate the value of a hotel, but it's not an appraisal, and it would not be considered to be an appraisal by any financial institution. But it's a quick way to estimate the value of a hotel, and not only is it quick, but it's cheap. The other thing, because it's free, the other thing is that if you look at hotel appraisals, the research shows that the average hotel appraisal will vary from a hotel sale price by about 5%. So this varies by 10%. So it's not as accurate as an appraisal on average. So I should caution you that. I was presenting this at the Hotel Brokers International Conference recently, and one of the brokers mentioned to me that it's interesting, but you know, typically an appraiser, when they're valuing a hotel, they know what the sale price is or the contract price is. And so given that this is unbiased, I think it has that benefit as well. So it's free, it's quick, and it's unbiased as well. So
I'm definitely not smarter than a fifth grader because I could not do that formula. We're going to have Jules Marling with RERC talk next about valuations and actual appraisals for hotels. And Jules, in a market where the NOI isn't strong enough to even cover operating costs, how do you assign a cap rate or a value to a hotel?
We keep hearing a lot about appraisals coming in a big, wide, crazy range of values right now. And that is just a function of the times that we are in, I believe. We're probably, we're definitely in the most unsettled market that we've ever been in, which creates terrific opportunities for some and terrific distress for others. And this reflects itself in the prices at which things sell. And the range is extreme. Things are changing as rapidly as they have been in the recent past. It's very, very difficult to take a specific number and say that that's the number right now. The other bad thing about appraisals in general is just because they get written up into a book and somebody pays a fee for it, the fact that the person has this book makes them think that somehow this value that they have is valid for a long period of time. But the reality in the real estate market is we have a bit of illiquidity always, and we don't have a continuous auction marketplace, and you can't always get out when you want to get out, but the prices at which you get in and get out can vary tremendously, and in time they can vary on the upside when things are really good, but on the downside, when the liquidity has been effectively drained out of the market, it's really, really hard to arrive at a value that will fit all. It certainly isn't a one-size-fits-all situation. We do these quarterly books called the Quarterly Real Estate Report that Real Estate Research does, and we do cap rates, discount rates, exit cap rates for all types of properties. The way we get this is we ask about 500 people every quarter about what their expectations are, what they're reaching for. It usually tends to be out in front of the NACREIF indexes, which are based on actual transactions by about 6 to 12 months, which all that really says is that people are, the investment people that we survey, which is a pretty good cross-section, are probably doing what they say they're doing, because it shows up in the actual results down the road 6 to 12 months. Now, I mean, this is, I'm not telling you guys anything you don't know already, but this decline that we've had here is by far the worst that has ever occurred. After 9/11, I think the decrease in RevPAR was 8% or something like that. The decrease that's occurred in the last couple of years, just as a result of this recession, is more than double that, 16, 17%. So this is an unusual situation. And the other thing about all the hotels is that a good percentage of the expenses tend to be fixed. And they're there, and there's something you can do about them. I heard they're taking the candies off the pillows at the Peninsula Hotel, but there's not a lot you can do with your fixed expenses. And the room rates, you got to rent the rooms daily, and the occupancy changes daily. So we have our RevPAR changing daily, and frequently in current times rather dramatically. And so we can swing from a profit to a loss, or from a loss to a greater loss, or till you get to the point where they got out here by O'Hare with this Intercontinental, where they decide they just can't afford to keep the place open anymore. Now, the last question is, how do you value a hotel? Well, you come back to what might a normal NOI be? I mean, and normal has a broad array of definitions. It also has and then you have to ask, when will this normal be here? And then you have to ask, how much will you have to spend to get to this normal in terms of CapEx or getting a PIP or whatever the heck you have to do. So, but it's not part of the work of valuing a hotel is to get to that normal.
We talk about cap rates and multipliers and indexes and whatnot, but the reality is, we joke about the panel is my hotel is worth what, but if you're going to go out and say we're going to do a valuation, whether it's a broker's opinion of value or an appraisal, the panel needs to be your hotel is worth this. If you're willing to put something out as a value without a tremendous level of confidence, then you shouldn't be putting it out. So, we spend a lot of time refining our product. We don't believe in legacy systems. We like backstopping it with indexes. We like backstopping it with looking at, where competitive product has sold. If the product we're looking at sold 5 years ago and 10 years ago, we want to see where other products that recently sold, maybe they sold 5 years ago and 10 years ago, and we actually see where the differences are. We use income capitalization, room revenue multiplier, comparable sales, and replacement cost, and then we discount and premium by market, by brand, et cetera. CapEx, we discount if it's deferred maintenance. We discount a portion of it if it's a PIP, et cetera. But then we run our cash flow analysis, and ultimately, if there's no yield, then the value's wrong, and we have to start over again. We have to determine what an acceptable yield is today, based on either an all-cash deal or where current debt is. And if acceptable yield is low teens, then the annual yield has to be in the low teens. If IRR needs to be above 20%, then it's going to have to wind up being over 20%. Then we can send it out, and we have full confidence. Everything's justified. Pro forma's based on an actual thought process, management change, inflation, capital improvement, brand change, et cetera. You have to have confidence in putting it out there. The frustration we've heard, and I imagine you've heard the same thing when we're doing work for servicers and lenders, is that they get valuations for the purpose of getting a listing, so it's inflated. They get appraisals that, from what I hear, are a lot more than 5 or 10% of where properties are actually selling. But the reality is there hasn't been a tremendous amount of product taken to market. If there's one luxury asset that goes to market, 4 months ago, and it's sold to a sovereign wealth fund or a very high net worth, international investor, the next month LaSalle buys a Sofitel in DC. Pebblebrook and Chesapeake are obviously buying assets, not off market, and the cap rates on these are really low. But when there are 10 upper upscale assets, in the Midwest on the market at the same time, or the Northeast or the West Coast, and 10 upscale and 10 institutional select service assets, that's when we'll probably start seeing some benchmarking. We can actually do some benchmarking. Today, if you're not doing it on a basis of the investor's yield, I'm not really sure how you can confidently say this is a value.
It might be 2 or 3 years before that asset reaches stabilization. Is that kind of what you're getting at?
Yeah, I mean, we do a 3-year, we always do 3-year stabilization, just like we always have. If you can beat it, good for you, but, you know, it's kind
Well,
of
and I think
insanity.
one of the things that Jules mentioned about an appraisal being as of a certain date is important because, you know, I think people do tend to think there's a shelf life to an appraisal, and the reality is it's based on empirical data that is retrospective. So while you can adjust that for cap rate for market expectations, it still is based on historical data, and appraisers, you know, get a little conservative in a market like this.
How much are you seeing that's being refinanced through REO, through lenders, or how much of it is in foreclosure, that they're actually buying the note before it actually goes back to the lender? How do you value that note, if it's a note sale or if it's an REO and the bank already has it on their books at a written down price?
You kind of have to go back to the market metrics. I think if you look at what's happening today, Smith Travel stats are showing RevPAR turned positive in May. And I think that's going to be the tipping point. If you look at REIT transactions, I was just reading a real estate, an RERC, not RERC, but Real Capital Analytics report that suggested that in 2009 there were 2 transactions that were REIT transactions. Year to date in 10, there are either closed or committed 33 transactions. So I think that's indicative that those guys, at least, are looking behind them and saying, RevPAR turned positive, we hit the bottom, we're going back up. If that equity capital that's in the marketplace, ready to be deployed, is going to be deployed at the bottom, they got to start looking and investing in assets today.
It's sort of a phenomenon that there's some frustration we've heard with the traditional debt clearinghouses, DebtX and First Financial, in that, you know, their valuation method is cents on the dollar. Here's your reserve pricing, and they want to see a little bit more of what's the underlying value of the asset minus the risk for buying the note and foreclosing yourself. If you're looking for a path to equity, and they're starting to look for better options on understanding the value of the asset, just like everybody else is. Though, and people are being more careful about who they're talking to in giving them their values, than certainly who they trust. So, I mean, people want to know what the hotel is worth, and they should, whether it's a note or whether it's obviously an asset.
So how long is that hold period today? If you're looking at buying a hotel today and you're saying that you need to value it as of 3 years today, what is the average hold period for the hotel owner today compared to 2006, 2007?
Well, so, you know, whereas people used to sit at the closing table and determine when the flip was going to be,
Right.
I think we're back to the majority of people are, you know, traditional hold periods. On the shortest end, 3 to 5 years, well, 3 years, traditional 5-6 years, and then the long-term hold, which is much more predominant today because we have owner-operators actually buying again.
And I think it depends on the deal too, because if it's a deep turnaround, you don't see a group entering into an asset acquisition like that unless they have an exit strategy.
Right.
They're saying, okay, I'm going to buy this, but I've got an objective. It's just like the stock market. You're saying, I want to accomplish this goal. Once I accomplish that goal, I'm going to sell this asset.
Well, and that's, yeah, absolutely, especially on the upper upscale, maybe luxury. But there are a lot of owner-operators that are focused on yield, that don't really have an intention to sell until someone makes them an offer they simply can't refuse.
Well, intuitively, though, I think they do. I think intuitively they're looking at, for economy segment, for instance, if you look at John's study that the index over the last 2 or 3 years, economy has lost 50% of the value, which is not surprisingly the reason that it's probably going to be the most to rebound on a percentage basis.
And so,
I think,
go ahead.
It's because the demand has traded up because they can do that because of the price change.
well, exactly.
Yeah.
But I think that even those buyers of that product intuitively have a strategy or an exit strategy where they're saying, we're going to buy it, it's doing $800,000 in room revenue instead of $1.5 million. I'm going to ramp it back up to $1.3 million, and then I'm going to sell it.
Yeah, and that's resulted in increased holding periods.
There's definitely not, I mean, there's obviously all ranges of investors' profiles. Some don't plan on selling, some plan on selling on a room revenue multiplier, some plan on selling on a per key, some on a cap rate, et cetera. But I think that, again, that's why it boils. I think that the annual yield is obviously far more important than it was 2-3 years ago when yields were zero. I mean, during every downturn, operators become better. I mean, good operators find the proper ways to cut expenses. I mean, obviously, legacy programs need to change. People find more efficient ways to operate and stuff that doesn't affect the guest experience. I think most of that's probably been figured out by now. And the cost cutting that's happening today may be detrimental, and that's where, it's important that both, integrity both on the operations side, on the expense management side and on the rate side is pretty crucial.
Those markets, and if you look at the STAR reports on a daily basis, and you start to see those Tuesday, Wednesday, Thursday night occupancies in the 80 to 90% range, that means there's some turnaway demand in those markets in the properties that are at the top of the fill pattern. That's when rate's going to be driven. It's not going to be driven because, you're paying extra for a flat panel TV. It's going to be driven because there's turnaway, and they can.
And the revenue management people in the gateway cities with the major chains are starting to push rates. You're seeing that in New York and Washington, for example.
We had that discussion yesterday.
And so, Jules, what kind of multiplier would you use on revenue for the next 3 years? On a hotel rate?
Net revenue?
Uh-huh.
I think it really depends on the individual hotel because you're talking about net income, net operating income. Because if there isn't any, you don't have anything to multiply by. And so I think it's a question of how quickly you can start turning the corner. And I think that varies a lot from situation to situation. I mean, like these distress sales that we just saw up by O'Hare, or seeing up by O'Hare. If a guy is buying at a 77% discount, he's a short-term holder, I assume, and he's going to work his way back up, and he's taking a hotel that's losing money right now, and he's going to get it to the point where it's making some money. But when you get all the way back to stabilization, I agree with whoever it is that said, I don't think you want to try and look more than 3 years into the future. But this future, the 3-year future is going to be a lot different for different types of hotels in different places.
Absolutely.
Okay, so let's talk about financing for a second. Besides the fact that there is no financing for hotels, where do people go if they're not an all-cash buyer?
There is financing for hotels. It's certainly far limited compared to where it was before. But being again realistic, if you're a good sponsor and you have a good track record, your long-term lenders are probably doing business with you, and there are lenders out there. I mean, it's not like the terms are ideal, but they're available, and so good sponsors have relationships. New good sponsors with good track records, individuals, they work through intermediaries to be introduced to the debt markets, and if the fundamentals of a deal are very good, there is a lender probably interested in doing that deal. It may be a little painful, but it takes time, and everybody has to be patient. We have to be patient, waiting for opportunities on the brokerage side. We work off hope certificates right now. Borrowers have to be patient as well.
And I think the lenders are going to dip their toe in the water on specific deals with great sponsors, great stabilized asset, great market, all the ingredients, and then you can get the debt.
So what do those parameters look like in terms of loan-to-value, debt service ratio coverage, guarantees?
Well, again, I think it depends. If it's a stabilized, courtyard in a major metro market, maybe it's 60% on a conventional deal. SBA is very active today on the $2 to $5 million assets for both 7A and 504 loans, and you can get up to 80% loan to value on those assets. This time last year, there was about $10 billion worth of troubled debt.
Yeah.
Now there's 30 to 35 billion. Mm-hmm. And it's, and although there's a little better deal flow, a little more transaction volume, going from 2 to 33 transactions isn't going to solve that problem.
No, and because there's something's going to have to happen here.
Right.
Yeah.
Yes, well, that's the other shoe that.
The special servicers are a very obviously important part of this picture. And if you've spent time with them, which is not that easy to do, they are, if you're going to be patient for anybody today, it's going to be them. If you want to do business with them, you're going to have to be very, very patient. Their process is very long. They get incredibly frustrated at people that offer to be a resource and then complain about not getting business in a short period. Their process of foreclosing with redemption periods is significant. And if you're...
Yeah, it's just a backlog. It's the funnel. I mean,
Yeah.
if you're at the very end, waiting for that signed listing agreement,
Yeah.
it's a long time.
They will say though that the business in their business is going to be significant. That this is not like it was, and they weren't around. Not a good comparison, but they've said, look, after 9/11, everyone expected the distressed opportunities. They didn't come. They will be here this time. Now, they are all, a lot of them, and they take different perspectives. They'll be making debt assumable, some of them, so there will be non-recourse debt available in that way. Some of them will not make debt assumable, but it's going to be a little bit of a waiting game. And it's interesting because you do read sometimes in periodicals, someone will say, whether it's a third-party management company or broker or whatever, if 25% or plus of the CMBS markets are in distress, where are the deals? Well, if you're not taking the time to understand those people's jobs, then you shouldn't say that you're going to be doing business with them.
Yeah,
Well,
it's not like it's not like in the RTC days when there was a mark-to-market requirement for those loans, and the values went from peak to floor immediately because of that requirement. Today, it's
Right.
it's kind of drifting off that cliff a little at a time.
Today, when do you start renewing that loan? When do you start talking with your lender based on today's numbers, based on numbers from a year to now? How many of those loans are going to get renewed, and how many hotel operators are going to be stuck looking for a new lender upon maturity?
If you know there's going to be a problem next March, start talking about it now.
Yeah. Communicate.
If you're current and in default, obviously you better start talking earlier than if you're current, and you have heard from your lender, obviously, if you're current and in default.
Correct.
Technically,
DCR,
you mean.
technical default, yeah. But if you're current and you're not in technical default, it's not as much of a concern. You probably think if you're within a year, you have started. If you haven't started thinking about it, yeah, you better.
Sale. What's the average time on market? And what's the average discount off of list price? Time you have?
We're not gonna really take listings for less than 6 months.
Yeah, I think we've gone from about a 6-month ask to a 9-month ask, and depending on the asset type, if it's going to take longer than that, a 12-month deal. But interestingly, it's that pipeline process. One asset, about a $5 million asset, fairly new, that I sold, went in contract in September, closed in April, had 8 extensions. And so, and it's that way with every deal. I'm not telling you guys anything. It just takes a long time to get everybody lined up.
And you can take, more time depending on your scope of services, and I'm sure there are a lot of groups out there. We'll spend, 12 months or more on a listing,
Yeah.
but we'll asset manage the property for that period to try to help improve revenues or NOI.
Well, if you consider the time that you're spending sort of courting the special servicer, it may be years where you're saying, okay, I know you've got this asset that you're dealing with. Here's a BOV, then you update the BOV. Then
It's years for the really good stuff.
Yeah.
It's not going to be years for the
Right, sure.
negative cash flow.
The time you dispose of an asset is at least 9 months, if that's what you're asking for in terms of a
Yes.
listing agreement.
Absolutely.
You can be less than 9 months.
Yeah.
We asked for 6. Certainly, we hope to be, under contract and transacted by the end of the 6-month period.
Well,
But
I think that's based on empirical activity. And if you look today, depending on the asset, if you've got institutional grade asset, I think you can sell that much more quickly today.
we just sold an asset. We sold it to a senior housing developer, actually. It was a hotel in downtown Fort Wayne, market that has new supply, and, very 6-month period it was a REO asset. We waited 6 months. We helped them find an operator, worked with the operator, and during those 6 months realized that the caps on occupancy and rate in that market made it highly unlikely that a hotel made a lot of sense.
The
And
highest and best usage.
yeah, so we market it to both communities, and we were very familiar because we'd spent so much time on the asset. It was only really 4 months, I think, to close. But for the record, the senior housing group, the first one we talked to made an offer. It was 30% higher than the highest hotel offer. So I know you've sold stuff to student housing. We have some assets. We're currently moving close to some student housing people and more senior housing. That's another valuation thing that people need to consider. And those, in a lot of cases, if you have an asset, it's a good box. It has the requirements of senior housing or student housing, which is fairly simple to figure out what those requirements are. That's another thing you need to consider on, whatever the simplest benchmarks are.
Absolutely.
That they can.
Well, if there's site value, I think that's another thing about the tiers of property. If you look at the mid-market with food and beverage assets, let's say it's a 40-year-old Holiday Inn on 10 acres of ground, an old U2 that has lost its flag and it's gone through the down cycle and it's independent, and it's in a good location, it's a tear down, and that's what we frankly need, is a little bit more of that.
I think that we haven't seen most of the variables. Right now there are a tremendous amount of assets that have 5 years or less left on their franchise terms that are unlikely to be renewed, and those properties have not really gone through the process and gone to market. The number of assets that need to be either torn down or adapted to different use, we don't know exactly what that's going to be like. And again, that's why I personally believe there hasn't been enough market to product to really set benchmarks.
We're all looking for increased revenue. How does hotel management employ good people, keep good people, provide a good customer service so there's some loyalty, some brand loyalty? How has all of this pressure in the downward pressure in the hotel market affected the actual management of these assets?
For example, at Penn State, we just graduated our largest class from the hospitality school ever at a time when it's probably about the worst period to find a job. And so the same recruiters are coming to campus, but they're offering many fewer jobs than they were 2 years ago. Last year wasn't very good either. The good thing is there's a lot of talent out there, and it's not just Penn State, it's Michigan State and a lot of other programs that are graduating good talent who are motivated and who've seen the light, because they're typically graduating without job offers or without multiple job offers like they had a couple years ago. So I think from that standpoint, there's good people who are energetic with talent and who are motivated and have employment experience and have good critical thinking skills who are available in the marketplace. So I think there's some good news, actually.
I'm particularly happy about the availability of intellectual capital right now. I'm enjoying it. I think that, Susan, from an operations standpoint, if there's an issue, or maybe the most glaring thing, is that in this downturn we're seeing who the bad operators are.
To motivate employees in hotels that are under foreclosure or hotels where they know that the owners are under duress, to keep those employees and know that their jobs are safe, and that the last thing, I shouldn't say the last thing, but it's very improbable that the lender will actually close the hotel and send everyone home. But to keep those people motivated and not looking for another job for 25 cents less is very difficult for a lot.
Bad news, but good news. There are opportunities for, up-and-comers in the industry. So
Yeah, a lot of good interim management companies out there that are taking over some of those bad performers and driving top-line revenue.
I think that
saving money.
I think we determined, and my partner Sanjeev does most of our asset management stuff, but I think on average, select service assets that we've been working on, the average cost savings that we found is about $150,000. That's stuff that can be implemented fairly quickly. And it's simple stuff like credit card commissions, where people should be at 2.1% and they're 3%, down to, elevator contracts. And maybe most shocking is real estate taxes. The properties that we've seen that no one is, that the owner or operator, whoever is responsible, has not contested real estate taxes over a 6-year period with NOI declining, because I don't know about all counties, but I know Cook County is that you're not assessed on operations, but you challenge on how the property is performing, and that is effective. Well, we had someone ask, one of the servicers we're working for had asked, well, is this a good operating company? And we said, well, they're not a lot, they don't do third party really, so I don't know. But by looking at their real estate taxes, I see that they are moving with where Cook County's assessments are, which is bad because they're down 50% in performance. That's a huge number.
Absolutely.
And it's quickly annualized and realized if
Sure.
it is a cap rate, income capitalization type of deal.
Well, I would imagine Cook County taxes are probably 5-6% of revenue.
Right. I mean, our
On a good
index,
day.
Is that right? Is that,
Yeah, we've seen assets up to 15 to 16%.
holy smokes, yeah.
the Penn State Index shows hotel values down 25%, and certain types like luxury down significantly more than that. But how many hotels' property taxes are down that much? Very few. As far as hospitality advisory services, a lot of our work right now is property tax appeals, and it's certainly something that every operator should be looking at.
There are very good appeal attorneys, I mean, obviously all over that, and they work off of a percentage of savings. So it's a no-risk, attempt to reduce your expenses. Unrelated. There is a tremendous amount of equity chasing these deals.
Absolutely.
The international equity set the pace. The REITs started matching it, and there's only more to come. I mean, there are a tremendous amount of hotel-only funds and funds that include lodging that are real funds. I don't think that, at ALIS, where everyone, including, I like to say, the bellman and the front desk clerk, had $1 billion to spend on hotels or hotel, I don't think that's real. But those that are real, and it's not hard to find out who they are, it's real money, and their appetite is good.
Yes, sir.
What approaches are you taking when you look at comp sales relative to the motivation of the sellers? I understand, in appraisal, it's, an arm's length and equally motivated and all those things that we put in the appraisal letter. But the motivation of sellers right now, especially when it's lenders, is, completely regulatory, or it's a real complex deal where there's a stack of debt and equity. So when you start looking at comps, to come up with a comp relative to the type of asset you're working with, I would think it's a little difficult.
Pretty small set of data. I know that about 25% of the transactions in 10 have been distressed transactions. And I think a bank is a seller. An individual can say, I'm not going to sell at that price, but a bank's going to be a seller as of a certain period of time. And so that does impact. And I think it's drawn that gap, bid-ask gap, closer. I think there's been some more movement because of that. But
in a lot of respects, the value that you have is a function of who your client is and what their objectives are. That's not because what they might get out of it and what somebody else want out of it and what somebody else might want out of it are two different things. And so the same property can have a pretty broad range of values depending on whether you're a lender with a regulatory gun to your head or whether you're somebody that's still got some cash that can ride it out for a while.
I can tell you, if you're an operator or an owner of a hotel, managing that appraisal process is probably the single most important thing you'll do in the course of your 12 months with your lender, because letting an appraiser walk your hotel without your guiding him, without your showing him increased trends, if you've had 3 good months in a row, it's important that you hand walk that appraiser through, because by himself he's going to float to the bottom with value.
It becomes really important if your NOI is negative, and if your revenues are really depressed, you don't have a lot of different methods to value that asset, and comps become incredibly important, along with replacement cost and any other metric that you can use. So, if there's 3 good comps over the past, 3 months, we're going to jump all over it.
What we do with the comps, though, is we use the old ADR rule of thumb, which is $1 an average rate per $1,000 in value per room. But what we find is that it values based on the type of property. And I've got a research article on my website which talks about this. But for example, an extended stay all-suite hotel pretty much follows that 1 per 1,000 rule of thumb. So Residence Inn with a $100 average rate is selling for about $100,000 a room. Whereas a mid-scale hotel with food and beverage that has a $100 average rate, it's actually one per 600. In other words, if that mid-scale old Holiday Inn has a $100 average rate, it's selling for about $60,000 a room. So we use the comps that way in terms of taking another approach to support the income approach, but we still conclude our value based on income.
That is a really, that's been a great thing to talk about when you talk about values, though, especially to, students or whatnot. That, simplest, that's what I was, taught, when I was working as, child slave labor, as my partner likes to say, in hotel properties by my father. And, in Chicago is a great example. Chicago's average daily rate has never exceeded $200. But if you go back and look at the transactions that happened in 2006-07, almost every, urban asset that sold at $300,000 plus. Very few of those deals were going to work.
Yeah.
So
right.
People that ask questions, why didn't this deal work? Why didn't it shouldn't have been really surprised. When you can point to something simple as that, it kind of sheds some light to those people, and maybe we need to think about the simplest things as well sometimes.
And for the comp sets that we all have been waiting for a year or two, at least I have, the idea was we're waiting for the distressed transactions to occur so that we can get those out of the way and scratch and claw our way back up so that the comps are more in line with what we'd anticipate. But not seeing the transactions that we were expecting, does that mean that you put the comp sets at a much lower value, or would you agree that will we see those transactions later, do you think?
Well, frankly, even the larger owners, institutional owners, larger hotel groups, it kind of seems like they're looking at early 2011 as times that they're going to be taking stuff to market. So, I don't know if it's going to be much before then. I think that based on the availability of data, that will certainly increase the way that we use comps, but it doesn't matter to us whether it's 12 months ago today or 12 months from now. We look at all four available the metrics we like to use, and we don't do appraisals, so it's just valuations. But we look at them and we weight them. We use usually any three of the four. It's either room revenue multiplier on economy, limited service stuff, or cap rate. Hopefully, anything that could be interesting to an institutional buyer. And if there's no NOI, we can't use it. So we're going to be using comp sales and replacement cost, and then use indexes or other metrics to sort of confirm, and yield analysis. So from availability of data, the better it is, the more we can use it. But if it's relevant, we're going to use it.
Well, just remember,
maybe a lot.
Just remember that if you have a loan, that appraisal is going to be underwritten and you're going to pay for it, but it's going to be written for your lender, not for you. So again, to go back to walking that appraisal through and do your own homework and go find comps that help you, because there's so few comps today. The nearest comp could be 500 miles away, depending on what kind of hotel you have. And if you don't manage that process, the lender's going to get the very low appraisal, and your loan to values are going to be out of whack. So you need to go do your own homework with the appraiser. Don't assume he or she is going to do it for you.
And I hate to say it, but both Eric and I and all the other brokers, we do opinions of values. And they don't cost anything.
Yeah.
We do them to advocate and to show you what true value is, in our opinion, and we do the best we can to justify everything that goes in there. And sometimes, from what we hear, is the processes that some of us have undertaken have exceeded those that they see from appraisers and other consultants.
I like to call it price, because I used to be an appraiser and I can't call it value.
Yeah, well, but so, it's that you should be utilizing obviously the resources that are available, and, I would just make sure to let them know that don't inflate it, And
I think somebody that understands the hotel business, you need to be careful when you're engaging the appraiser, or the bank's engaging the appraiser.
The brokers.
Okay, thank you for your time this morning. The panelists will be at the back of the room should you have questions for the next few minutes.